Hi, I'm Jeffrey Panic, financial advisor and author. We're halfway through the year, and that makes this a great time to pause. Look at your financial picture and ask a simple question. Am I still on track, or am I accidentally creating a tax surprise for myself? Too often, people wait until January, February, and March to think about taxes for the previous year. By then, many of the best planning opportunities are gone. A mid-year tax review gives you plenty of time to adjust before December 31st. In my books, Your Future is Now, an introductory guide to managing your finances, and Your Future is Now, your blueprint for solving your retirement puzzle, I talk about the importance of building a plan instead of simply reacting to life as it happens. Taxes are a perfect example. The goal is not just to file a return, the goal is to make intentional decisions throughout the year. Today, I want to cover four areas to review: Roth versus traditional IRAs and workplace plan decisions, charitable giving, required minimum distributions, and capital gains and loss planning. Roth IRA, Roth 401ks versus traditional. First, let's talk about Roth IRAs versus traditional retirement contributions. The IRS says that the total amount you can contribute to all your traditional and Roth IRAs combined is limited each year. For 2026, that limit is $7,500 or $8,600 if you are age 50 or older. Assuming you have enough taxable compensation, Roth IRA contributions may be limited based on income and filing status. But for many people, the bigger decision happens at work. How much to put in a traditional 401k or 403b versus a Roth 401k or Roth 403b, if your plan offers it. A traditional 401k may reduce your taxable income today, while Roth 401k contributions are made after tax but can provide tax-free withdrawals in retirement if the rules are met. Coordinating your IRA and workplace plan decisions mid-year can help make sure you are filling the right tax brackets for both today and tomorrow. So the question is not simply, can I contribute? The better question is, which account tax bucket makes the most sense right now? A traditional IRA or traditional workplace plan contribution may offer a current year tax benefit if you qualify for a deduction or pre-tax treatment. A Roth IRA or Roth 401k does not provide an upfront deduction, but qualified withdrawals later may be tax-free. If you believe your tax rate may be higher in retirement, all the government debt that we will all eventually have to pay, Roth contributions, whether in an IRA or in a Roth 401k, can be attractive. If your current tax rate is unusually high this year, a deductible traditional contribution may deserve a closer look. This is not a one-size-fits-all decision. It depends on your income, your tax bracket, your retirement timeline, and your need for flexibility. Mid-year is a good time to revisit your pay stub, your contributions, and your projected income to see whether any adjustments make sense. Number 2, review charitable giving. If generosity is part of your financial life, mid-year is a good time to ask whether your giving is also being done efficiently. The IRS generally requires taxpayers to itemize deductions on Schedule A to deduct charitable contributions, and gifts must be made to qualified organizations. That means you want to think before you write the check. Should you bunch multiple years of gifts into one tax year? Should you give appreciated securities instead of cash? And do you have the proper receipts and acknowledgments? For cash gifts, the IRS requires records such as a bank record, receipt, letter, email, or payroll deduction record showing the organization, date, and amount. And for contributions of $250 or more, a contemporaneous written acknowledgement is generally required. If you are already in the phase of life where you are taking required minimum distributions from your retirement accounts, another tool to consider with your advisor and tax professional is the Qualified Charitable Distribution, or QCD. A QCD allows eligible IRA owners to send up to a certain amount per year directly from an IRA to a qualified charity. For 2026, this is $111,000, and that amount can count towards your RMD while potentially keeping it out of your adjusted gross income. Coordinating your RMD and QCD strategy at mid-year gives you time to decide how much you want to give, which accounts to use, and when to send those gifts. Giving is personal, but when it is planned well, including options like appreciated securities and QCDs, it can support the causes you care about and still fit into your broader tax strategy. Required minimum distributions or RMDs. Third, if you are in or near retirement, review your required minimum distributions. The IRS generally requires withdrawals from traditional IRAs, SEP IRAs, simple IRAs, and many other retirement accounts when you reach age 73. While Roth IRAs do not require RMDs while the owner is alive, however, beneficiaries may be subject to the RMD rules. This matters because RMDs can affect your taxable income, your Medicare premiums, the taxability of Social Security, and your overall retirement cash flow. If you wait until the end of the year, you may be forced to take a larger distribution at a bad time. A mid-year review gives you the room to coordinate your RMD with your spending needs, your withholding, your charitable plans, including whether a qualified charitable distribution makes sense, and your investment strategy. Capital gains and loss planning. Fourth, review capital gains and losses. If you have taxable investment accounts, do not wait until December to look at realized gains and losses. The IRS generally treats assets held for more than a year as long-term and assets held for 1 year or less as short-term. And short-term gains are generally taxed as ordinary income. If your capital loss is exceeding your capital gains, the IRS generally allows you to deduct up to a limited amount each year, with the ability to carry forward additional losses. This is where tax loss harvesting can come into play. But remember, you should never let the tax tail wag the investment dog. A tax move should still fit your long-term plan, your risk tolerance, and your portfolio needs. An example in action. So let's put this together. Imagine a married couple in their early 60s. They're still working, they give to charity every year, they have a taxable brokerage account, and retirement is getting closer. At mid-year, they review their tax picture and notice several things. Their income is higher than usual this year, so they compare whether a traditional IRA or traditional 401k contribution could help reduce current taxable income, or whether a Roth IRA or Roth 401k contributions still make more sense for long-term tax flexibility. They realize their charitable giving is spread out in small gifts. They ask whether bunching gifts into 1 year, donating appreciated stock, or using a qualified charitable distribution once RMDs begin might be more efficient. Even though they are not taking RMDs yet, they begin projecting future distributions so they can understand how those withdrawals may affect retirement income and how qualified charitable distributions might eventually play a role. They look at their taxable investment account and see that they have some gains and some underperforming positions. Instead of waiting until December, they talk with their advisor and tax professional about whether harvesting losses could help offset gains. None of these actions by themselves are magic, but together they create a more coordinated plan. That is the real value of a mid-year tax review. It is not about predicting the future perfectly. It is about giving yourself enough time to make the thoughtful decisions. As I say often, your future is not something you should leave to chance. Your future is now. If you would like help reviewing how your retirement income, workplace plans, IRAs, charitable giving, and investment accounts fit together, including strategies like a Roth 401k contribution and qualified charitable distributions, start the conversation before year-end pressure sets in. I'm Jeffrey Panic, financial advisor. I appreciate you watching.